This is one in a series of videos about foreclosure and about the terms that surround foreclosure. This video is about loan modification. Loan modification is the process by which you approach your lender and request that they modify the terms under which you repay your loan. Primarily, this is to reduce the payment on an ongoing basis to more accurately reflect your ability to currently pay that loan. There are other forms of modification. For example, a forbearance agreement. A forbearance agreement is an agreement where the bank agrees to forbear on its rights to foreclose against you in exchange for you getting back on track with your loan. What that means is that you come up with the lost payments, the missed payments. Most loan modifications involve an analysis of your ability to pay. That includes what percentage of your income would be required to make this mortgage payment. Right now, the analysis that's been done by federal authorities and banking authorities is that 31% of your income is a good number, meaning that if you make $100,000 a year, $31,000 of it can go to pay for your housing. If it exceeds $31,000 based on that hypothetical, it would be more likely that you would fall into trouble in the future and potentially be foreclosed on again. If you pay less, then maybe you're paying too little, and the people that hold your note aren't getting their fair share of the money. So 31% is the number. The analysis of what they include in your income is limited to what is described as stable income. Stable income is income that can reliably be expected to be received in the future. If you have income that fluctuates from time to time and place to place, for instance, if your part of your business is to sell items at garage sales are not reliable sources of income. They are reliant on the weather, they are reliant on how many people show up that day, they are reliant on the type of materials that you have to sell. If you're someone who receives tip income and your income fluctuates by the season, they will only use an annualized estimate of your income. This is difficult for you if you actually make money and don't report that income. Modification requires that the income be reported verifiably, either through taxes, by withholding, or by your own reporting if you're self-employed. In addition, the lender is going to look at how many assets you have. Do you have other financial assets that could be tapped into to catch up the loan and thus make the loan good again? If you don't have any financial assets and you don't have any income, or if your income is really quite a bit less than what it was when you took out the loan, it is unlikely that a modification is going to take place. In addition, an important consideration for you as the homeowner is that when you apply for a mortgage modification, a loan modification, the legal steps that the bank is taking to secure its collateral, your home, are not going to stop. Modifications are occurring on the same track in terms of time as the effort of the bank to come and take the home. If you start a modification and your lender tells you you are in a temporary period of modification, that does not mean that the time limits and or your obligations under either a court case or a sale by publication in a non-judicial foreclosure state, that they stop. The bank may proceed on both tacks at the same time without notice to you, other than the notices that are required by law. This is very important for homeowners who have entered into temporary modification arrangements. Generally, the lender will stop or pause on its foreclosure activity to determine whether or not you're going to make it through the modification process, and in addition, whether or not the ultimate holder of your note. The bank is not typically the holder of your note, they are the servicer. Whether the holder of the note will agree to the terms that you and they have come together on in terms of the modification. So if previously you had been paying $1,000 a month on your mortgage, and you have now reached a temporary modification arrangement to pay $800 a month, your servicer and you have reached those terms together, and you've started to make payments. That does not mean that the ultimate holder of the note has agreed that they will accept that modification as a permanent modification of your loan. They have allowed you to remain in the home while they evaluate whether or not your modification is one that they're willing to accept. Their decision is based on numerous factors, not the least of which is their perception or anticipation of what their recovery might be if they took the house back from you and sold it on the open market. There is an estimation, generally speaking, by most holders of mortgage notes that many in the community have failed to make mortgage payments simply so that they can qualify for a mortgage modification, a loan modification. You, in fact, may have been told by the servicer of your loan, by the bank, to whom you make the payments and who collects those payments on behalf of the mortgage holder. You may have been told by that bank that you will have to stop paying your mortgage in order for a mortgage modification to be accepted. If a servicer tells you that you should stop making payments on your mortgage in order to qualify for a modification, you need to be aware that that does not mean that you in turn can expect that they will not foreclose against your home. They may choose ultimately to foreclose against your home even if they were the ones that told you to stop making payments. When you are approaching a lender on a loan modification, you are notifying the lender that you are at least in distress and at most unable to pay the mortgage payments. This notice puts them aware of the fact that you are in trouble and that they might end up having to take the house back. When that happens, they treat you entirely differently than they have up to that point. They treat you as a problem and not as someone who is attempting to reach a solution. You need to understand that in approaching your lender for a modification, you are taking a serious risk with respect to your home. That's not to say that you shouldn't take that risk. It's to say that you need to be aware of it. If you're approaching your lender for a modification, you should contact an attorney in your area. In addition, if you are notified after you've started a modification that a foreclosure is pending or is proceeding, you should immediately contact an attorney in your area, as your rights and responsibilities have time limits associated with them. You should make that contact immediately. Good luck.